In finance, there's this core idea that smart, rational traders should always be able to fix mispriced stocks. But what if they can't? Today, we're diving into why this so-called smart money doesn't always win. So here's the big question. The classic theory says that if a stock is obviously priced wrong, rational investors should just swoop in, trade against that mistake, and push the price right back where it belongs. I mean, that's the whole idea behind an efficient market, right? But if that's really true, why do we see these crazy mispricings stick around for so long? That's the puzzle we're going to tackle. To really get to the bottom of this, we have to start with the textbook solution. See, traditional finance has this really powerful idea for how markets are supposed to police themselves, and it all comes down to one word: arbitrage. This whole thing is built on the famous efficient market hypothesis. The core belief is that even if you have a bunch of irrational investors making crazy bets, it shouldn't really matter. Why? Because the smart money is always lurking, ready to bet against them, buying what's cheap and selling what's expensive. In theory, their actions should always drag prices back to their true fundamental value, making any weirdness just a short-lived blip on the radar. And the tool they use to do this is called arbitrage. The easiest way to think about it is like finding free money just lying on the ground, a guaranteed, riskless profit. This simple act of picking up that free money is supposed to be the engine that keeps the whole market efficient. But, and this is a big but, that perfect risk-free world, it pretty much only exists in textbooks. And this is where our story takes a really sharp turn. Because the moment we step out of the classroom and into the messy, chaotic real world, that beautiful, clean theory of arbitrage runs into some very, very big problems. You see, the problem is that real-world arbitrage is almost never riskless. It takes capital, often a lot of it. And here's the absolute crucial part. Just being right isn't enough. The market can stay irrational a lot longer than you can stay solvent, and prices can move violently against you before they finally correct. This really shows you the massive gap between the theory and what actually happens. The textbook ideal is this perfect, risk-free force that fixes prices instantly. But in the real world, arbitrage is a risky, capital-intensive bet where the correction might take forever, if it happens at all. You're constantly exposed to the risk that the mispricing gets even worse before it gets better. So these arbitrageurs face some very real dangers. Of course, there's the fundamental risk that the price just keeps moving against you. But the really critical constraints, they're financial. You've got funding risk. That's when your own investors see short-term losses and start pulling their money out. And that can trigger the dreaded liquidation risk, where your lender hits you with a margin call, forcing you to close your position at the worst possible time, locking in a huge loss, and completely failing to correct the mispricing. So what does this kind of breakdown actually look like in practice? Let's walk through the anatomy of a failed arbitrage trade step by painful step. Okay, so imagine this. Step 1, you're a rational trader, you see an overpriced stock, and you short it, betting its price will fall. But then, step 2, the bubble keeps inflating. The price actually goes up, and suddenly you're showing massive paper losses. This is what triggers step 3. Your nervous investors start calling, wanting their money back, or you get that margin call from your lender. You're out of options. Step 4, you're forced to buy back the stock at that new, higher price just to close out your position. And the final result? The original mispricing you tried to fight isn't just still there. Your forced buying might have actually made it worse. And this is so important to understand. The trader wasn't wrong. They were completely rational. But their rationality wasn't enough. Their failure didn't come from a mistake in their logic. It came from a capital constraint. They just ran out of money. And this proves that mispricing can stick around, even when all the smart people in the market know it's there. This brings us to a much more sophisticated and, frankly, more realistic view of how markets actually work. It turns out efficiency isn't some constant, universal truth. It's conditional. What this really means is that market efficiency isn't like an on or off switch. It's not a law of nature. Instead, whether or not the market is efficient becomes totally conditional. It depends entirely on the financial health of the market's biggest players. Specifically, efficiency depends on the health of financial intermediaries. We're talking about the big banks, the major hedge funds, the dealers who have the capital to actually perform arbitrage. When these players are well capitalized and feeling good, their capacity for arbitrage is high, and any mispricings get corrected really quickly. The market looks efficient. But when they're distressed, say during a financial crisis, their capital dries up, their capacity for arbitrage becomes weak, and those same mispricings can just linger or even grow. This completely changes how you have to think about asset prices. A price doesn't just tell you about a company's future earnings anymore. It also tells you something about the health, the risk appetite, and the funding constraints of the big financial players who are actually setting that price at the margin. So this gives us a totally new metaphor for the market. It's not just a giant information processor. It's better to think of it as a network of interconnected balance sheets. And the strength of that network is what ultimately determines how well the market can actually set rational prices. And that leaves us with a final, really challenging question to think about. When a price moves, is it reflecting new information about the actual asset? Or is it just reflecting the health or sickness of the balance sheets that are doing the trading? The answer to that redefines what a market price truly represents.